You look at, for example, the BRICS, which Andrew, you and I have talked about a lot. We're very close to issuing their unit gold-backed currency over mBridge, but at the 12th hour, the BIS and Augustus Carstens pulled the plug. The BIS Innovation Hub was helping China, Hong Kong, Thailand, and the UAE develop mBridge and also to run the unit settlement token, who Dilma Rousseff, the former president of Brazil and the head of the New Development Bank, said we've agreed in principle to this, basically Sergei Glaziev's idea that has now materialized. And at the 12th hour, the BIS says, well, we can't be involved with any country like Russia that's being sanctioned by the West. It's as if they just realized over the last 4 years that Russia was the R in BRICS. And so they've pulled back from this. But in essence, what they are doing until they get a more cohesive settlement currency, and a platform to trade over, I think that they realize that the need for the U.S. Treasury is fleeing, and instead they would use gold as a neutral reserve asset to settle their trade surpluses. So in essence, what you're seeing are these countries who realize the West, whether it be the United States through what he calls, President Trump calls tariffs, they're actually sanctions masquerading as tariffs. You don't say 100% tariff if you don't do this. That's a sanction, and that's a threat. And instead, they're accumulating gold, which has doubled the performance of the 10-year Treasury for the last 25 years, but has no counterparty liability. It's also been reclassified by the BIS as something tier one or high quality liquid asset. And all of these things, you put them all together and it becomes very obvious that these countries have chosen to shed treasuries and to accumulate gold instead of those treasuries. And I think that is a trend that will continue, absolutely. A comment made by Pierre Lassonde, and recently the cumulative volume on the Shanghai Metals and Futures Exchange combined surpasses that of the COMEX, making it the number 2 most actively traded center for metals. Pierre Lassonde just came out and said, the day the Shanghai Gold Exchange surpasses the COMEX in transactions will mark a seismic shift. Gold's pricing power will move decisively from the west to the east. Summed up, the gold price will ultimately be decided not in the United States, but in the East. How close are we from that moment where these fugazi numbers that you can trade at such massive, distorted levels of paper contracts to physical behind it? At what point, like you said, is it over like that? And now the nations who understand and accumulate and respect what these assets really are and what they mean, the pricing will move that way. And what does that say for the LBMA and for the COMEX and for this country, for the whole Western system? You could argue, if Pierre is right, we're close to that happening, because those two exchanges combined, the Shanghai Metals and Futures combined, has now surpassed COMEX. So how far away are we? I'm not sure, but he would tell you probably closer than most people think.
The global financial system is undergoing a radical transformation, one that many mainstream economists and media analysts either fail to recognize or deliberately choose to ignore. This shift is centered around the waning dominance of the US dollar as the world's primary reserve currency and the rise of gold as a neutral settlement asset. The tectonic plates of global finance are moving, and gold is at the center of this transformation. While Western central banks continue to play financial games with inflation, interest rates, and debt monetization, the East, led by China, Russia, and the BRICS nations, has quietly been accumulating gold at an unprecedented pace. The implications of this are enormous, and it is only a matter of time before the balance of financial power moves decisively away from the West. One of the most telling indicators of this shift is the steady de-dollarization by major economies that once relied on U.S. treasuries to shore up their reserves. This movement away from U.S. treasuries is not a random event, but a well-calculated decision by central banks worldwide to hedge against the declining purchasing power of the dollar. The mainstream media portrays the U.S. Treasury market as the safest asset class in the world. But is it really? If a U.S. 10-year Treasury yields 4.5% annually, while inflation erodes the purchasing power of that currency at 7 to 8% per year, then bondholders are guaranteed a real loss. This is precisely why central banks, particularly in the BRICS nations, have been dumping U.S. treasuries in favor of physical gold, a tangible asset with no counterparty risk. The most recent reports show that China, Saudi Arabia, and Russia have been engaged in massive gold purchases, often outside the official records of the IMF. China's reported gold purchases have significantly understated the actual amount they've acquired, with import-export numbers revealing much larger transactions than officially declared. Beijing has been stealthily acquiring gold through private channels, including direct purchases from miners and through its central bank proxy banks, ensuring that its real gold reserves remain a state secret. This is not an isolated event, but part of a broader strategy to gradually decouple from the US-led financial system. The US Federal Reserve and other Western central banks, on the other hand, continue to maintain the illusion that inflation is under control and that the dollar remains as strong as ever. However, the reality on the ground tells a different story. The purchasing power of the dollar has been eroding at an accelerated pace, with consumer goods, housing, energy, and essential commodities rising much faster than the officially reported CPI numbers. Anyone who has filled up a gas tank, bought groceries, or paid rent over the past decade understands that the actual rate of inflation is significantly higher than the government statistics suggest. This is where gold and silver come into play. Unlike fiat currencies, which can be printed at will, gold and silver are finite assets with intrinsic value. Gold has been used as money for over 5,000 years, and unlike paper currencies, its value is not subject to the whims of central bankers. Silver, often referred to as gold on steroids, has a unique advantage in that it is both a monetary metal and an industrial commodity. With increasing demand for silver in the technology, energy, and medical sectors, its long-term value proposition remains extremely compelling. In the midst of this monetary transition, the role of gold in international trade settlement is becoming more significant. The BRICS nations have been working on a gold-backed settlement system that would bypass the Western-dominated SWIFT payment system. Although the official announcement of a BRICS currency has been delayed, the underlying strategy is clear: to reduce reliance on the US dollar and use gold as a neutral reserve asset to settle trade imbalances. This trend will only accelerate as more countries seek alternatives to the current dollar-centric system. The US government's response to this shift has been a combination of economic threats and policy maneuvers that serve to maintain the dollar's global hegemony. One example is the proposed 100% tariffs on BRICS nations, which is not so much a tariff as it is a financial sanction aimed at punishing countries that move away from the dollar. However, this strategy is unlikely to work in the long run. Rather than forcing countries to continue using the dollar, these aggressive policies are only pushing them further into gold and alternative trade settlement systems. The coming years will be a defining moment for those who understand this shift and act accordingly. For investors, the time to accumulate gold and silver is now, before the next financial crisis forces the mainstream to wake up to the reality of a declining dollar.
Well, and Andrew, you track this every week with your great videos. I mean, most people remember it just back in last May when all of a sudden the Shanghai price was about $3, more than 10% higher than the COMEX, and you started to wonder, well, who's really got the pricing power here? Because you can't, if the Shanghai price were to go to 35 and COMEX still at 30, and you're like, well, wait a second, what's the real price? They got to somehow keep them closer together. And so you wonder, will we get a couple of other surges like that, even in just speculative buying in China this year with this moderately loose policy? What if all of a sudden there's a big surge on the Shanghai exchanges of new speculator buying, you know?
And there is, because
there you go.
If you look at the data reports from the Shanghai in the last couple of months, and I noted this on a video a few weeks ago, as a percentage of transactions, the Shanghai has a higher physical percentage. I think in gold it was 78%, and silver, I forgot what it was, very high. But then in the last report, I think in December's report, those had come way off, meaning is more speculative positioning going on in Shanghai. As a percentage of transactions, physical has come down. Why? Because all that paper is entering. So you're starting to see that paper entering the Shanghai market. It was in the last data report, and I don't know if when January's out. It's probably not out yet. But they do those reports every month. You can look at them on Google and pay attention to the percentage of physical delivery. And not only had the percentage gone down to physical delivery, but the amount of trade, the notional trade had gone up as well. So that's people coming in speculating on that market. Is those people in the West speculating on that market? Who's doing that? Somebody's coming over.
Well,
And we also seen a little bit of dip this year dating back to the summer in terms of COMEX trade as well. So maybe that's signaling a shift, from west to east in terms of that speculative positioning.
And think of it this way too, the Fed floods liquidity and all that ends up in all of our markets and all that, and we know it's not gone into gold and silver and the mining share has been in Bitcoin and all, and the big seven or whatever they're called and all that kind of stuff. Well, they can't trade Bitcoin in China, can they? Yeah. Right? Isn't it a little illegal? Do they even have
to be able to? Yeah.
Yeah. Okay. So China issues all this moderately loose liquidity. It's going to go more into, again, silver contracts in Shanghai, gold contracts in Shanghai, copper contracts in Shanghai, that's where that liquidity is going to flow there. And again, forces the banks to go, oh man, what are we going to do here? They have to let price rise so it doesn't get detached. Mm-hmm. So again, all part of these forces that are underlying the markets is here as 2025 begins.
The global economic landscape is shifting at an unprecedented pace. And as this transition unfolds, gold and silver are set to play a greater role in preserving wealth and reshaping the financial system. The United States, long accustomed to having the world's reserve currency, is now facing a stark reality. The dollar's dominance is fading. As we move into 2025, the warning signs are everywhere. The reckless expansion of debt, endless money printing, and inflationary policies have accelerated the de-dollarization trend. Nations that once relied on the U.S. financial system are finding alternatives, and the one asset that is emerging as the primary replacement is gold. China, Russia, and the broader BRICS bloc have been aggressively accumulating gold, often in ways that go unnoticed by Western analysts. While the official numbers reported by China to the International Monetary Fund, IMF, suggest moderate purchases, the reality is that their gold accumulation is far greater. Analysts tracking gold imports through Shanghai and Hong Kong have revealed that China is likely stockpiling 10 times the amount of gold they officially disclose. Why the secrecy? Because gold is not just an investment for China. It is a strategic asset that will be the foundation of a new financial system. Beijing has been actively acquiring gold through discrete channels, including direct purchases from miners and sovereign wealth transactions. This secrecy suggests a carefully crafted strategy to reduce reliance on the US dollar while preparing for a global monetary reset. The US government's response to these global shifts has been a mix of economic threats, aggressive tariffs, and financial sanctions. The proposed 100% tariffs on BRICS nations are nothing more than sanctions in disguise, an attempt to punish countries that dare to move away from the dollar. But rather than dissuading them, these aggressive measures are pushing them even further into gold. The move to isolate Russia and China financially has only accelerated their efforts to create alternative trade settlement systems that bypass the dollar. And let's not forget Saudi Arabia, a critical US ally for decades, which is now selling oil to China in yuan instead of dollars. This is a direct attack on the petrodollar system, which has underpinned US economic dominance for over 50 years. As more oil-producing nations move away from dollar settlements, the demand for US treasuries will plummet, leading to higher inflation and higher interest rates in the United States. At the heart of this transition is gold's reclassification as a Tier 1 reserve asset by the Bank for International Settlements, BIS. This 2019 decision elevated gold to the same status as US treasuries, effectively signaling the return of gold as real money. Western investors, still distracted by stock market speculation and cryptocurrency trends, failed to grasp the significance of this event. But central banks around the world took note, and the result has been a record-breaking accumulation of gold by sovereign nations. Gold's resurgence is not just a reaction to economic uncertainty, but a calculated move by major financial players to realign global trade and monetary policy. One of the clearest signs of this realignment is the emergence of Shanghai as the dominant force in gold price discovery. For decades, the COMEX New York and LBMA London have dictated gold pricing, primarily through paper contracts that do not require actual delivery of physical gold. This system has allowed the West to artificially suppress gold prices, maintaining the illusion that the dollar remains the safest asset. But this manipulation is breaking down. The Shanghai Gold Exchange now rivals the COMEX in daily trading volume, and Pierre Lassonde, one of the most respected voices in the gold industry, has predicted that the day Shanghai surpasses COMEX in transactions will mark the end of Western price control. We are dangerously close to that moment. In mid-2024, the Shanghai gold price premium surged to over 10% above COMEX, a clear signal that physical demand in the East is overwhelming paper contracts in the West. Once the disconnect between paper and physical gold becomes too great, arbitrage will force Western institutions to capitulate, and the gold price will skyrocket. At that point, those still holding dollars and treasuries will find themselves caught in a historic loss of purchasing power. For decades, investors have been conditioned to believe that stocks and bonds are the only reliable assets for long-term growth. But this modern portfolio theory is based on an assumption that the financial system is stable, an assumption that no longer holds. The cracks in the system are widening, and gold is emerging as the ultimate hedge. The world's wealthiest investors, including sovereign wealth funds and central banks, are moving their money into hard assets. The massive insider selling we've seen in U.S. equities, including figures like Jeff Bezos and Mark Zuckerberg unloading billions in stock, suggests that those with inside knowledge are not betting on the stock market's continued growth. Instead, they are positioning themselves for what's coming next. Gold is not the only metal set to benefit from this seismic shift. Silver is also poised for an explosive breakout. Silver, often referred to as gold on steroids, has an unparalleled dual role as both a monetary metal and an industrial commodity. The demand for silver in solar panels, electric vehicles, and 5G technology is soaring, yet the supply is failing to keep up. The mining industry has been underfunded for years, and the silver market has been in structural deficit for over 4 years, meaning more silver is being consumed than is being mined. The price manipulation in silver has been even more egregious than in gold. The gold-to-silver ratio, historically averaging 15-1 when both metals were used as money, now stands at an absurd 85-1. This means silver is trading at a massive discount to gold, and when the revaluation happens, silver is likely to outperform gold dramatically. Investors who understand this relationship are already accumulating physical silver, knowing that once the suppression scheme collapses, silver could surge 2 to 3 times faster than gold. This is why owning physical gold and silver is critical right now. ETFs and paper contracts will not protect investors when the inevitable happens. The COMEX and LBMA have long relied on leveraged paper trading, where hundreds of contracts are issued for every 1 ounce of actual gold available for delivery. But when the crisis unfolds and real demand overwhelms these paper markets, those holding physical metal will be the real winners. As Andy Schectman often warns, the last place you want to be during a gold rush is holding a piece of paper that says you own gold. You need to own the real thing. The Western financial system is at a breaking point. The US dollar is rapidly losing its global influence, central banks are preparing for a monetary reset, and gold is returning as the premier asset of choice. We are witnessing a once-in-a-lifetime shift where the wealth that has been built on debt and fiat money is being transferred into real, tangible assets. Gold and silver are not just investments, they are insurance against the collapse of a failing system. While Wall Street continues to chase artificial profits, the world's smartest money is moving into precious metals. The US government, burdened by over $36 trillion in national debt, cannot print its way out of this crisis without destroying the dollar's purchasing power. Inflation, interest rate hikes, and geopolitical instability will only accelerate gold's ascent. The next phase of this financial revolution is approaching fast. If you're waiting for a better price to buy gold and silver, you may wake up one day and find that the reset has already happened. Those who have prepared will emerge on the right side of history. Those who have ignored the warning signs will face financial devastation. So the question remains, are you ready for what's coming?
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.